Welcome to Your Money, Your Call. It's a Friday edition of Bonds versus Equities, and joining me tonight on the show is Gavin Madson. On my left, Gavin is a credit analyst at FIIG, and Rudy Philippek Van Dyke, and he's from FN Arena. They're here to answer any of your questions. Feel free to give us a call on 1300 30 34 35 and the email yourmoney@skynews.com.au. No glasses, so I'll go to you first. You can prove your brain.
No
I know. It's a glasses
thing. You look
thing.
more funky.
Does it?
Yes.
That's why you don't wear the tie.
I'm the guy with no tie and no glasses.
No, okay, so you better be smart. How's business? It's the first time you've been on the show this year, so
It's true.
How have things been?
Well, I think 2014 will. Well, there's now clear indication. I think both from surveys and from anecdotal evidence that 2014 is the year that the investor from the sidelines is coming back to the share market.
You think so?
There are clear indications that's the case, yes. It's happening right now.
Mm-hmm. What is share market volumes doing? I mean, what is it?
Well, I was about to follow on with that one, and I happened to notice that from this week, you see the volumes being relatively high.
Yep.
Well, they're not relatively high, but compared to what we've seen so far,
yep,
the volumes all of a sudden seem much higher.
Yep.
Which I think underpins again that investors are now coming back to the market. It hasn't so far translated into gains because the share market, strictly taken, is still lower for the year.
Yeah.
Many stocks are still lower for the year, the likes of BHP, Rio, etc. But I do think it probably translates into support. I think the share market itself refuses to fall a lot. I think that's where the money comes in, I think.
Yeah, right. Gavin, welcome. When I think of what Rudy's saying, and we hear BHP and Rio and they're now a dividend play, and they're trying to mirror what the bond market has given people, which is consistency of earnings. And the way I think about it is it's that capacity to replace revenue. You know, older people are buying things that, because they can't go and get a job, they want to have a regular earn, and so that's why they've responded to the dividend. But it's been interesting how that equity market has performed, hasn't it, compared to the bond market. The bond market is just sort of ground in and in. And for the viewers at home, grinding in and in is a good thing if you own credit. You know, you make money. How is it different at the moment between equities and fixed income?
Yeah, what we've seen in the equity markets over the last 18 months in Australia, certainly, it's that low TD rate. So people are
that appropriate TD level, thank you, from the NAB. Thank you.
Okay, yeah, sorry, a great term deposit rate from the NAB, and you've got as you say, you've got retirees who need an income. So what are they going to buy? They need to buy equities that have a good yield.
Yep.
What we've seen in management in response to that is how do I keep my management CEO? He worries about his share price because that's what he's going to get his bonus
Absolutely.
on. So how's he increase his share price in a market which is has got some weaknesses around? It's improving as you've noted, but there's some weaknesses still in the equity market. We're certainly coming the other side, I think, now. But as a CEO, how do I protect my shareholder value, and in particular, how do I keep the share price up so I get my bonus?
Yep.
Well, if I increase my dividend, I'm guaranteed I'm going to attract some investors.
We saw probably what I would call the most embarrassing case of this embellishment was Woodside, where they gave special dividends and increased the dividends for no reason. It's an oil and gas company. It should be spending its money on exploration. What did they do? They gave money to shareholders. Why? Because it kept the share price up.
So when
Well, the bond guy is criticizing Woodside.
Yeah,
It's not true. If you go to the UK and to Europe, the big oil companies are really good payers of dividends. Royal Dutch Shell pays you 5% year in, year out. So Woodside is actually now falling in line with international practice.
But is that?
Anyway.
But is that? I mean, so let's expand on that because it's true, and I think it's interesting how it's changed. And I think of maybe BHP and Rio as the greatest advertisements of the change, where they used up a lot of capital to grow businesses. There's two questions I need to ask you. One is, where is the growth aspect of somebody's portfolio? And a balanced portfolio, they need to have a growth aspect. Now, if BHP and Rio are your dividend plays, that's a challenge. That's hard to understand how they're a growth aspect.
Yes.
And then, when I hear stories about, and we'll talk to the viewers later about the copper collateral in China and the impact on ore, and all of a sudden I look at the chart for Rio. I tried to bring it up last week, but we had some troubles with charts. Yeah. It's just, it's rapidly falling. So I'm getting a 3% dividend, but my share price is not performing at all. Yeah. How do they get those two problems together?
Okay.
So I'll be short. Yes. What's the growth? What's the growth part of the portfolio, and how do they recompense the fact that they lost price?
I suspect that on one end you're asking the right person, on the other end you're actually absolutely asking the wrong guy.
Okay.
here's the thing. My feedback from the financial industry is that those people who are now sitting in TDs finally come over the bridge and go, listen, I want to put some money in the share market. They are very cautious. They're only putting parts and often the minority in the share market, and they have no appetite in BHP and Rio.
Yeah.
So they don't want to go for the volatility. That's that part. The other part is that I've been saying for 2 years that that industry is changing, and that the big guys, Woodside and Oil Search is about to come. Santos going to be the same thing. We get BHP and Rio will be all the same group, and they will all of a sudden become a cash flow play.
Yeah.
Which means they will have lots of cash. They will have difficulties in consistently growing their earnings, which means share price appreciation will be more difficult on a consistent basis, but they will become cash plays.
Yep.
And so basically they will look in buying their own shares, support share price, and they will looking into extra dividends and increasing the dividends. And the irony is that a BHP, which is definitely the better play in that sector, on that perspective, is offering you now 4% dividend yield fully franked.
Yep.
And that's almost like a bank, with increased volatility and obviously with a much larger dependency on what happens in China. The irony is that, yes, the share price is still quite volatile, but you will see that the share price of Woodside is in a very narrow band, because it basically trades between 6 and 7% dividend yield. That's Woodside now. And to come back to the growth aspect, well, I disagree with the criticism of Woodside, because in my view, and the same is going to happen with BHP and with Rio, those companies are effectively ex-growth, in my view. And Woodside, the same thing. Woodside's revenue from oil, in the absence of a considerable increase in oil price, which I don't think is around the corner, is going to peak this year, now. So after that, we get a sliding scale. All the growth projects they might have on the agenda, that's 2018, 2020. So it's going to be a while. And in the meantime, they have cash. And they support their share price by putting on a 6 to 7% dividend yield. If you can't live with that, then Woodside is not your stock.
Yeah.
But I think the time is over that you would buy Woodside to see it go from $30 to $60.
Right.
That time is not anymore. We've had that in the earlier years of the decade. And I've been saying this for 2 years, by the way, and I see now gradually that a lot of experts and analysts and commentators now gradually finally come to the realization that this is actually transforming the upper level of
they're just going to be dividend plays. Get rid of the cash. And of course, Gavin, when they decided to do that, it was devastation in all the other sectors in terms of the mining support sectors. They just got absolutely crushed. And that's when we started to have the RBA talking about the transition mechanisms from mining to non-mining. Just adds to the volatility. What were your thoughts when that started to happen, when they started to say, we're now dividend plays? Did you foresee that sort of, as an analyst, that...
You could see it coming. There was just way too much heat in those markets. In the mining markets, you had, you looked at the salaries and you saw the increase in salaries and the amount of people that were flying up there, the fly-in, fly-outs, all that stuff. You just start to go at the point, is it crazy to pay $130,000 a year to someone who's got unskilled labour? And you start to go, when you start asking those questions, yeah, that's probably the time where you think they're going to have to pull back.
Yep.
The mines, especially those coal mines, the thermal coal mines in central Queensland, some of those are fairly marginal businesses. And when you start paying that sort of wage level, at some point there are purely basically a DCF calculation for those mines. The DCF stops making money.
Do you want to tell the viewers what a DCF is?
Yep. Basically, it's a valuation technique for companies. And you look at, we've got a mine that's got a 30-year life, we've got a coal price that we think we've got for 30 years. If we dig up X tonnes times 30 years, we've discounted back to the current price of the value of that mine.
Yep.
When it becomes negative, it's no longer a viable mine, you mothball it, and that's what happens. The tail end of that is that you get your small mining services companies start to find trouble because they've built up for a massive boom, and they don't have the ability to turn the tap off so quickly.
Right. Now, we've got Gavin here to do a lot of the stuff on the analytical side, so we will come back after a very quick break and we'll talk more analytics, and Rudy will talk about whatever he likes, because that's what Rudy does. We'll be back to you soon. Welcome back to Your Money, Your Call. It's bonds versus equities. And joining me tonight on the show is Gavin, Madson, a credit analyst at FIIG, and Rudy Philippek van Dijk, who's from FN Arena. They're here to answer any of your questions. So feel free to call us, 1300 30 34 35, and the email yourmoney@skynews.com.au. And we have our first caller for the night, and the caller is Eric from Sydney. Hello, Eric. How can we help you?
Mark. Rudy is one of the best analysts I've ever seen on TV. But what I'd like to ask Rudy, I heard you say, like over the last years, that BHP has been one of the best dividend players on the market, gradually increasing dividends over the last 10 years. And just the opinion, I mean, with all this quantitative easing, and say it's pulling back, and we do have inevitably an inflation spike, don't you want to own hard commodities, i.e. BHP and Rio? Thanks, mate.
Okay. Well,
we'll get both of you to answer that question.
I'll just take the compliment. Well, I've never said that BHP is one of the best dividend payers, but it's one of the most solid and reliable ones.
Yep.
Because it has in the past not been a dividend play, but if there was anything you could count on over the past 10 years, BHP has consistently increased its dividends. Not even the banks have managed to do that in the Australian share market. Now, what have I done in recent times? I've discovered that BHP tends to find support at 4% dividend yield.
Yeah, right.
So every time the share price falls, and you will find, for instance, this week, there seems to be a support there. It's around 4%.
Yeah.
Which obviously you can integrate that in all kinds of strategies. I mean, when people ask me, when do I buy BHP, I go, you just wait until it hits 4%, and then that's when you buy it. Because BHP hasn't done anything over 7 years, the share price. It hasn't done anything since late 2011. But if you bought at 4% dividend yield level, you still have made a profit, apart from the dividends. Now, the other question was the spike in inflation. See, I don't believe that's around the corner. I don't think that's happening. I think too many people ignore the differences that were there in the Weimar Republic in Zimbabwe and what's happening around the world now. All the money that's printed is there's no velocity in the US. I recently saw, again, velocity basically means the speed with which money travels around through the economy. And it's, again, in the US, it's basically the all-time low. So money is not going around. The labor market is in very dire straits. We get all kinds of new technological innovations, robotics, you name it. If anything, we're definitely in a period of disinflation and
I think it's the jobless recovery that drives it all, and also the oil price.
There are more parents to the result. But,
absolutely.
But actually, what I want to say is there's no hyperinflation around the corner.
No, definitely not. What's your thoughts on that question? And you're a pretty good analyst as far as I'm aware.
Yep, Phil, thanks for that. We'll disagree on Woodside. I agree on BHP. I'm a liker of BHP. I think it was when they tried to buy the Canadian potash assets a couple of years back, the fact they missed out on them I think was a good outcome. And I think their potash business that they're trying to grow from a greenfield, I think that's a better way for them to go. It avoids the risk of overpaying, and I think they probably would have overpaid at that stage just because markets were toppy.
Yeah.
I remain very positive on BHP. I like the spread of commodities. I think they've got some great projects in Africa that are available to them.
Yeah.
I think they can avoid the expenditure in Australia, which is, like I said, just the cost base in Australia is very expensive. You've got assets outside of Australia where I think they can add value to their business.
And what's your thoughts on the inflation piece?
I actually saw an interesting one by Magellan put out today, and they are very good. They're very bullish US equity and very bullish on a steepening curve in the US, which obviously indicator of inflation for them. That will no doubt under their theory, would no doubt tail back into Australia just because that's the way it works. I'm probably more on the Rudy side. I don't see it, like you say, it's that. Well, it's the good side, obviously.
I think it's not tapering that's going to cause the inflation. There's nothing in the US market, and it is driven predominantly by jobs. I really feel I understand about innovation, but that requires capital expenditure. And one of the things that's been very clear that in the US there hasn't been that much capital expenditure. They've been putting the money back, right? So capital expenditure.
Australia's not happening either. So businesses are not spending. They rather pay out a dividend. I was
going to say they're busy giving out dividends. They should be spending money, mate.
Yes. That's my point. Yes. Where do they play as a growth asset in a portfolio? Leave the bond market to do its job. Go and do your job. Grow.
Exactly right.
That's the key to it.
Yes. Although although devil's advocate would have to say that we all agree that business is not spending and the economy is growing, at some point that will have to be inflationary because there's not enough capacity then, and they have to invest them in.
Sure.
But I think that's still years into the future, I think.
I think it's absolutely years.
Also because the US economy is not going to grow by 4 or 5% like it used to. I mean, let's face it. I mean, 2.25 or whatever, and they all jump in the air because it's fantastic, and that's basically what we're having, isn't it?
And it's hardly even covering employment. You know, it's hardly even covering the people coming into the employment, that sort of growth. And I think that's the challenge for the US at the moment, to try and, you know, my interpretation of interest rates today, this week we had the FOMC coming out, and for the viewers at home in the Q&A section, Janet Yellen responded to the question, and I'm paraphrasing, interest rates will be held for a long time at these low levels. What is a long time to you? And she essentially said, oh, well, you know, 6 months. And in terms of the market's perception of a long time, it certainly isn't 6 months. So I think her PR people will be talking to her about, hang on, let's get that right. Because that created some havoc in the market.
Considerable time, you go like, well, that's 6 months, nobody was thinking about this.
No one thinks 6 months. 6 months is 2 futures rollovers. Who cares?
Yes.
Tell me what you're seeing with your clients. What trends are you seeing with the clients?
Well, I think what I see is definitely that there's what as I said earlier, it's across the industry, we feel it as well. There's definitely new people entering the market. There is definitely more optimism about those who are in the market. But the irony is also, and this is also what we see as well, and there's some anecdotal evidence, and it comes out of the surveys as well. There's a class of investors who was earlier in the market and who has made a very good run over the past, let's say, 18 months, who's actually now withdrawing money out of the market. So they're obviously skeptical about, and it comes back to the irony of the share market, because everyone who comes now to the share market will find that all the good stocks, all the quality ones, all the ones that performed are they look expensive. Yeah?
It's very hard to find value in most things.
No, but that's the share market. Yeah, it's you come late. Well, all the guys in front of you have pushed up the price, and they all look quite expensive. That's the reason why everyone is, and the share market is actually quite funny. Everyone is on the sidelines now, sitting like, let's hope for, fingers crossed, for 5 to 10% correction. And you know what happens? It probably won't happen then, because there's too many people waiting on the sidelines.
Yeah, no one's in there. I mean, also, it's probably not warranted. There's just not seeing the growth. We haven't got the economy charging.
Not warranted. I actually think, and I've said it earlier in the week, I actually think that the Australian share market is about to be hit by downgrades now. For one reason is because commodities like iron ore and copper are now much lower than what people thought they would. And I think the second thing is that there's too many companies are reliant on a very good second half to make their guidance. And I think there's quite some doubt creeping in.
We'll talk about that after the break. We have to go there. We have to leave it for another very quick break. Erin's telling me we need a word from our sponsors. Talk to you soon.
All right, kids, come inside!
Look, Chloe. We got an open door policy.
Hey, shut the door.
Oh, we don't have to worry about that anymore.
Oh, really?
New Mortein Nature Guard Auto Protect Odorless keeps bugs out for you. It's adjustable, works automatically, and its odorless formula contains 98% natural ingredients. So it's tough on pests, not people.
More smart, more safe, Mortein.
John West endures the worst, so you can be your best.
Slippers, mate. Mate?
No one likes fungal nail infections, but there's a file-free solution. Rejuvenail kills the fungus without needing to file your nails first. Rejuvenail. Do your nails a favour.
These leading manufacturers recommend only Finish as the #1 brand. Now, the best ever Finish Quantum with Power Gel delivers a pre-soak action for an amazing clean and a brilliant shine no one else can beat. That's why Finish is the #1 brand trusted by Australian mums. Finish Quantum with Power Gel, our best ever.
Welcome back to Your Money, Your Call. It's the Friday edition of Bonds versus Equities. And joining me tonight is Gavin Madson, a credit analyst at FIIG, and Rudy Philippek van Dijk. He's from FN Arena. They're here to answer any of your questions on the bond or equity markets. The number 1300 30 34 35 and the email yourmoney@skynews.com.au. And we have our first email for the night, and it's an email about inflation. And when it comes up, I'll be able to read it to you. I often hear people say cash is a bad investment as it is eaten away by inflation, but if inflation rises, doesn't that mean that the RBA will raise cash rates? And this, ... will then flow to the bank interest rates. So doesn't cash therefore protect you from inflation? What do you think?
It doesn't grow. That's the problem. Like yes, and there's absolutely also a delay factor which you might be, but cash never grows. And that's, I think, that's when people go, what you should do. That's what the share market offers. The share market offers not only that you, let's say for the sake of argument, say a certain stock gives you 5% dividend yield this year.
Yep.
It should give you 5 point something next year, and maybe in 3 years' time 6 point something. So you're actually growing. On a very good scenario, the value of your shares should grow, and the yield what you're getting for shareholders should grow as well, and that obviously is a double protection against inflation in theory.
Let's have it. Both barrels.
Yes. You know what I'm going to say, because you know it's my favourite topic.
Bring it home, baby.
There is only one true hedge against inflation in the Australian market.
And what is that?
That is an inflation-linked bond.
Oh, my God.
Which, surprise, is linked to inflation. Because
or an index annuity, that's right, an index annuity bond linked to inflation.
The name says it all. Now, it grows with inflation. Every quarter CPI comes out, the bond value goes up by that amount. That's how they work. That is the only true hedge. Now, equities, okay, you get growth. But there's no hedge. It's not a natural hedge of inflation.
Everyone says Transurban. That's the stock standard. John Pearce from Uni Super came out and was bashing me over the head with Transurban. But that comes back to the question of what I first started, which was portfolio construction. Yeah. I have some concerns about inflation. I will buy an inflation-linked bond. That's covered. Yeah. I have concerns about growth. I'll buy some growth stocks. That's covered. I have dividend plays. I'm going to buy those 4. I'm not going to, if you XYZ company want to tell me your dividend plays, let's see some performance, and I'll buy those.
But if you bring that back to the question, see, both a inflation-linked bond will rise as inflation comes. Cash will never give you the yield on cash might rise a little bit, but you're paying tax on that anyway.
So Tom was talking about the fact that the RBA would lift rates, and therefore you would get the benefit because you're in cash, and that's the historical perspective of what they do. That's what they do to stop inflation. Yes. Unfortunately for the RBA, they've said over the last 20 years what we knew to be true is now turning out to be not true. So interest rates are lower. I can assure you more and more customers are buying term deposits. I understand that on the edges people are going to the side, but the charts on term deposits, there's 610 billion in deposits, and it's just a hockey stick. They are much more conservative. Combination of getting older, they just don't like volatility. So deposits are growing. If things aren't as they normally would be, like rates lower, you wouldn't have deposits. People go and take risk. The RBA is saying that's my conundrum. So I don't know that they can afford to lift rates if they saw inflation. They try and jawbone it a bit. They would be very slow to move on rates because the consumer can't absorb it.
Yes.
That's what
that's their key concern. Is I don't want to push inflation by talking it up, and I talk it up by lifting rates.
Yep.
They get concerned. They start to chase each other. So the cash rate will remain lower behind the inflation rate. The inflation rate will move before the cash rate will. And that's about exactly what you were just saying. The RBA won't want to move straight away. They don't want to jawbone. They just want to keep people, settled effectively.
And keep spending.
Yeah, and that's the problem, because unemployment's still moving probably the wrong way. There was good numbers for absolute jobs, but the actual percentage that came out last week, I think it was it was heading in the wrong direction. So the cash rate they're not going to move up on inflation on cash regardless of inflation, because they want to get the unemployment moving in the right direction. So you're going to get that delay. And for that whole time that you're delayed, you're losing money because you put your $100 in your TD at the start, you get $100 at the end.
Yeah.
And you roll that over, it's just going to happen.
And you spent the interest.
Well, I was about to say, you have $100 in cash. If you're lucky enough that you can live off your interest and you don't need to touch the cash, but it'll remain $100. And there's no growth there.
And the banks going back to the TD rates of 2007, 8, 9, where it was 9, 10%. And I'm not, just because I work at the NAB, I'm not trying to defend it, but it's just impossible. If cash rates are where they are, you know, at the moment the bank spreads are in the hundreds. So you get about 110, 120 over the cash rate for a TD. So historically, that's a massive spread. That's huge. Isn't it?
It's fantastic. And like, you know, I've looked at the history of part of our business is, you know, fixed income includes looking at TDs, and the spread's amazing. It's much better than where it was. Much better than it was.
Absolute rate. It's just that people are going, okay. And I think that's the, you know, we've heard the CEOs of the various banks say, I need to be able to explain that better. And they haven't been able to explain that better because people don't understand, you know, wholesale funding. They just don't understand how that works. And that's the challenge for the CEOs. As an analyst, tell me what you'd look for. Now, you do credit now,
yep.
but as an analyst in general, what would you be looking for?
Fundamentally, you look at the same things, as whether you're an equity analyst or a fixed income analyst, but the detailed stuff of what you look at changes. There's two areas in a business. You've got your finance risk and you've got your business risk. Your business risk is what's the industry, what's your position in the industry, is management good, what's management decisions history is like, have they bought assets that they shouldn't have bought, have they overpaid for assets in the past? So you look at that stuff. That's your business risk. Financial risk is all about your gearing, how much debt you're taking on, the mix of equity and debt, is that appropriate for your industry? You're in an infrastructure business, you can gear a company to 80%, and it'll be comfortable because you've got infrastructure type returns, which is you get cash paid by a government, or you know you really know what your cash flows are.
Yeah.
You're in a cyclical industry, like for instance, we're talking about the mining services industry, which is extremely cyclical. It goes up and down with the mining booms. You don't want to lend those guys a lot of money. They've got to have a low gearing, and that's the combination of that business risk and finance risk is how you analyse a company.
Sounds good. We'll talk a little bit more, because what I want to try and do is get how you're both looking at different... I want to try and get the viewers to come to grips with the idea that you've got an equity analysts and you've got debt analysts, and how they should start to get up to speed on how to do it differently.
If I would summarise, I would say that's the balance sheet there. Here is growth, otherwise there's nothing here.
Yeah, here's the story. I've got to believe the story.
Otherwise
we have to go to another very short break. Please feel free to call us, 1300 30 34 35 for any questions on investing. The email you're wanting at skynews.com.au. We'll be right back. Welcome back to the show. We've got Gavin Madson on the show with Rudy Philip Van Dyke. Philip Van Dyke. I'm Mark Todd from the NAB. We're here to talk about the various analysts that there are in the market. We're going to have a continuum of the conversation around what an equity analyst does and what a debt analyst does, and then we'll go to some emails. So let's talk about the equity analyst. We just had Gavin talking about what he's doing. Let's talk about what you're looking for as an equity analyst.
My experience is people always mix these two things up. I always hear people say things like, oh, BHP has a great balance sheet and it's a large company, but you always go like, yes guys, but where's the growth?
Yeah.
I mean, because it is, people underestimate this, but share market is about growth. There's no two ways about it. And people always say, like, but they're still making money. And if they were making more money last year, more money the year before, the share price would probably go lower. Yeah. And that's what you have to take into account. So people, I always found that the smarter guys are in the debt markets. Unfortunately, that's the case. And in the share market,
I'm not going to disagree.
And in the share market, people use everything and what they can get and just use it often in the wrong way, in the wrong context. But in general, I would say share market is about growth. And obviously, you still have to figure out whether not fiddle with the books or...
Yeah, so the research guy is making sure that the books are okay, that the data is appropriate, they're not hiding things. And then he's trying to articulate whether that story leads to growth, whether that business business mantra is creating
Because even with the whole emphasis on dividends, you still have to... You will still find that with all the fluctuations, those dividend stocks that have growth behind them are the better performers.
Yeah. Okay, so tell me about how does that compute? What are you looking for? How do we differentiate between debt guides versus what Rudy was just talking about?
Yep. I guess fundamentally, if you talk about what might be good for an equity and is bad for fixed income, and vice versa. We talked about paying a lot of dividends, some of these companies paying a lot of dividends recently. Well, that's a bad thing for fixed income, but it's great for equity. It's a great equity story, and that's helped their price.
So the reason being, for the viewers at home, is they're getting cash out.
Every time they give cash to these equity guys, I can't have it.
Yeah.
I'm effectively, as a bond analyst, I'm a banker.
Yeah.
I want the money. It's mine.
He's an owner, you're a lender.
As far as I'm concerned, it's my money, and any time they take it away from me, I'm not happy.
Yeah.
Sure, and I think this is a really good point. I mean, we're interested in growth. He's interested in getting his money back.
Yeah, it's a binary experience. Have I got the right return and will I get my cash back? You're saying, do I believe your story, whoever your management team is, do I believe the story?
I'm basically saying, will you be bigger next year and bigger the year after and bigger the year after?
So dividends you don't like because you can't get access, and you don't like from a perspective. You're not saying don't give dividends. You're saying the reason you don't like them is the cash goes out, but they all have to pay dividends.
That's right. But
what do you like?
What I like, there's nothing I like more than I was going to say nothing I like more than a highly dilutive equity raising, but that usually means a company's in trouble. But apart from that, that means cash for me. That's more cash for me. What I like to see, I like to see a nice strong market cap, because I know all that market cap has to disappear before I get touched.
So by that, for the viewers at home, what he means is if a company is worth $1 billion in equity and you have $200 million in debt above that, you are senior to that equity, that $1 billion has to lose all its value before you're in threat. Now, essentially, common sense tells me that if there's $1 billion behind you and your $200 million issue, they probably will spend the $200 million to get you out of the way, because you've got first lien on all those assets. So whatever that $1 billion company owns, when it gets wound up, you get it first. So they want you out of the way so that they can get it.
Yep. And fundamentally, if you think about the CEO, if he does something that's not great for equity guys, okay, he's going to get a rap over the knuckles. But that's it. He'll probably keep his job. And you can run through the list of CEOs in Australia who have done bad things for their equity holders and still have their jobs and got great bonuses. If you do something bad for a debt holder, goodbye.
Yeah.
We'll take the company. It doesn't. There's no discussion about it.
People underestimate the power is with the debt.
The power's with the debt, and what I love is that the debt is viewed as riskier than the equity. I mean, that is the great irony. Now, we have got time for, we've got another email. We have an email from Peter, and Peter writes, I would like to invest in US Treasury bonds. I believe as an Australian resident this is not possible. Can this be done through a fund? The thing with funds, Peter, is that you could do anything. So, yes, there would be some fund in the world, like a PIMCO sovereign fund. There'll be some sort of fund that you could buy into. My question is, to some extent, why you would want to do that. So we don't know enough about your circumstances to offer advice, but in general, they're pretty low yields, and if you're not in that market on a regular basis, it's hard to get control of that market. Does that make sense?
Yeah, very much so. Yeah. But yeah, as you say, without knowing the actual circumstances, difficult. Is he trying to play a US dollar?
You might have dollars. Yeah. You might be long natural dollars.
The other thing is, if he is inexperienced and just doing it on the go, he's probably going to lose money, I would say.
Well, you may lose money, Peter. We hope you don't. But, I think you could find some other better exposure to US dollars. I mean, you can get...
No doubt there's an ETF out there that does the
US dollar term deposit.
You could buy a US dollar NAB hybrid.
Yeah, that's right.
That would be my recommendation.
Yeah, that's right.
If you wanted exposure to the US dollar...
That's a great bond.
You get an FX rate. A TD in America is probably going to get you about...
No, but you can. But the NAB hybrid in dollars, I bought that. It's a great bond.
It's a cracker.
It's a cracker because it's the old structure, and we had them. I bought it in euro. You can buy it in dollars.
I think it's a 2015 maturity.
Because that's when we're punching out all these things globally, and it's not as easy for them to do now. They don't do it.
No.
It's all in the got the COCOs. So you look at previous issues to what they now issue, and you go, hell on, I look at the previous issues because they get redeemed. You presume they're going to get redeemed, and they were trading at a discount because essentially the people that were selling them were offshore, and they're saying, what is a NAB?
Exactly right.
They had no idea about this thing called the NAB. What is that? Yeah. And they were thinking Clydesdale Bank, and they were saying sell it. And so you were getting this. I got NAB euro at 500 over the cash rate.
And crazy. And the reality is, there's an analyst like me sitting in London, and he's going, I've got NAB, who I have no idea about, and I've got Barclays. It may not be as strong a peg as NAB, but I know Barclays. I don't have to think about it. I'll keep the Barclays, sell the NAB. You come in and buy it.
I've got emails arriving today. English people saying, I want to buy Lloyd's and sell Westpac because I don't know enough about what Westpac's doing. Really? That's extraordinary.
Yes.
And that's for Australian residents, you know, trying to give them some advice. And I think that's the problem with global markets. If you to Peter's email, if you invest local, you are more control of what you feel comfortable with.
Yeah. Well, if Magellan is correct, then if he goes into treasuries, he's going to lose a lot of money.
Yeah, absolutely. If Magellan, but that's a big if.
Correct.
That's a big if. If Magellan's correct.
But even if you would expect that bond rates will normalise, whatever that is, you're still going to lose money. Because they're too low.
Yeah.
That's why,
on a market basis,
that's why I don't understand, unless he has some secret plan somewhere.
But on a market, he'll lose money. But if he just holds the bonds, he'll just get 2% or whatever he's going to get. You know, it's
and I
don't get me wrong.
I'm
not saying don't do that. I'm not saying that's what he should be doing. But he won't necessarily lose money. It's only if he has to sell it.
Yes.
We have to go to another very short break. Please feel free to call us on 1300 30 34 35 for any questions you have on investing in any country. And the email is yourmoney@skynews.com.au. We'll be right back. Welcome to Your Money, Your Call. It's the Friday edition of Bonds versus Equities. Joining me tonight is Gavin Madson. He's a credit analyst from FIIG, and he's not too bad at it. But Rudy Philippek van Dijk, who is fantastic, and he's here from FN Arena. They're here to answer any of your questions. Feel free to call us 1300 30 34 35, and the email is yourmoney@skynews.com.au.
Must be my birthday.
Must be. Let's talk about the fact that the markets have been volatile, and I just want to understand what you think of that, like, and how that plays out. I'm conscious of the fact that the stockbrokers are not making the money they had, and I wonder how that pressure will ultimately play out. You know, you can deal for $7.95 or whatever you can do. What sort of service will our viewers ultimately end up with?
Well, what stockbrokers need is that they need volatility, because if everything just is a placid lake, then there's nothing to sell, basically, because nothing goes up or nothing falls. But the people who are coming in the market right now, they have obviously been on the sidelines, and there's a reason for that. They don't like the volatility. They don't like to buy Qantas at $2 and see it go to $1. I mean, even if it goes back to $2, it's a heartache.
Yeah.
They don't like that stuff. And my understanding from the financial industry now is that those people who are now allocating some of their cash to the market, they have low appetite for BHP and Rio. It's too volatile.
Yep.
The problem for those people is that the stocks that are low volatile and have performed very well, and amongst the ones I research as the old stocks, I mean, those guys are trading on PEs past 20.
Right.
So that's the problem for those people. They go like, well, they'll be the next one who buys Telstra and the next one who buys Woolworths, arguably at quite inflated asset prices.
Yeah.
Maybe they should be buying BHP at 4% dividend yield, but they don't like the volatility.
You're right.
And they don't want to go there. So it is a little bit of a what the stockbrokers need is a few months of upwards moving share prices, and then the thoughts about volatility disappear. But right now you see that it's again there.
Because that business model may not be working in a way, you know, going forward, how this plays out. Because
stockbrokers like to get you into stocks that go up.
Yeah.
Because at least you feel good, because you bought yesterday and it's still up today, and it feels like the stockbroker gave you the right stock.
There's some challenges in that. Mate, I want to ask you about for the viewers at home, on, I think it was Wednesday, there was an article in the Financial Review, and it was talking about, from the ASX, was saying that in June there will be legislation taken to the Parliament, and it will be called simple bond legislation. Now, let's say they take it to the lower house. There is some bipartisan agreement on this, and it'll have to go up into the upper house, you know, to see, let's say it goes through in July, and, you know, maybe by the end of the year it'll get ratified. What it will do is it will open, its intention is to open the bond market to retail investors, so that they'll be able to see bonds on the Australian Stock Exchange, and they'll be able to buy bonds in, you know, denominations of $1,000. I don't think we've seen the final draw of the legislation. But, mate, what did you think of it?
Well, as you said, it was just an article, so we didn't see the detail. We saw them, the Labor Party took similar legislation, basically the same legislation to Parliament before the election, and but it got to the point it was just about to go through the final ascent through the upper house, and they called the election, so everything got halted. So
all that legislation goes to one side, and we'll come back and review it.
That's right. If they put the same legislation word for word up again, I think there's still some difficulty with ASX listing, and it's around director responsibilities.
Yeah.
So can
you just explain to the viewers at home what that concern is? Because that would be helpful?
It's no surprise if you're a director of a company, you don't want to lose your house.
Yep.
And if you're going to the market making calls about what the risks are for your business and you don't identify a risk, you may be
liable.
And that's what they're worried about.
Whereas the equity market, you said...
Equity market can do whatever. We're talking about the amazing thing where bonds are the lower risk end of the spectrum, but it's easier to do equity. If I want to do an equity raising, if I'm a listed company, I want to do another equity raising, I just put out a press release. I'll do it.
Prospectus. You have to do a prospectus.
But you have to do the original prospectus, but you pump it out. But I think that maybe the reason for that is that because the bonds are so much safer, you have to take on more responsibility because you are deemed to be paying that out. So the bonds themselves aren't more risky.
Well,
it's just
it's about. I mean, you own them.
Yeah.
And with equities, no, you don't owe them anything.
Somebody else does.
They're officially your owner, but in practice, if you're small fish in the pond, nobody listens to you anyway. But there's an AGM where you have your voice heard. But in essence, there's a difference. Yeah? If I owe him money, I'm basically I have to pay him back.
But fundamentally, what's the difference between doing a bond on the ASX and a hybrid? If you buy a hybrid, people expect to get their $100 at the back end.
Absolutely.
So, why should it be that much harder?
Yeah, I think that it's going to get there, and the reason why I feel like it's going to get there is because of what I think of as the government's response. And the government has a problem. It can see the growth in superannuation pool, and it doesn't know how to tax it. And it can see the growth in the population, the ageing of the population in particular, and it doesn't know how to fund it. And it says all the liability lies with me, the government, because if you run out of savings as a self-funded retiree, you can get a pension. And it says, hang on, I've got all the downside and very little of the upside. Even though they tax it at 15%, the government would say 15% is not worth anything. Yeah. And I think that there's no politician in the planet who's got the skill set to explain to the Australian people how we can take more out of the superannuation. And rightly so, I don't want to see them do that at all. No. But that's the challenge, isn't it?
Excruciating. But then the other thing is, the one thing I would add to that is, if interest rates normalise in the years ahead, it will become less of a problem because bond yields will be higher and even cash rates will be higher. So yeah. I know it's a problem now, but we have to realise that interest rates are at an all-time low at the moment.
Yeah, but I think they're
artificially so.
Yeah, but when you look at the ageing population.
This is my bread and butter basically. Yeah. The ageing population, they've got to fund themselves. How do you make sure that you've got? It's not for fixed income. It's not about return on your money. It's return of your money.
Yeah.
So you don't want to be retiring at 2007, because if you retired in 2007 at the hit when the GFC hits, you're in strike because you've got to convert all your assets and you're going to do whatever you need to do to retire, buy your boat, buy your caravan and travel. Well, you've got to do it when the share price is at a low end. So by having a bond market, you just flatten it out a little bit. Okay, you look for your growth in your equities, and you look to pay your bills with your fixed income. And that's how I look at it. It's at a very basic level. You pay your bills with fixed income, you get your upside, you have your European holiday on your equities.
Yeah, and I think that sort of makes some sense. But that's all part of the education. That's why I'm saying the government will drive that conversation. They will say, we are making this change in legislation because you need to take this ownership around paying your bills, as Gavin's talking about. Because if you don't, then we'll start to force you to do that. We'll actually make you work longer, which they're going to do. Yeah. So retirement age will be pushed away. And then they'll start constructing portfolios that they want you to buy to. And I see that happening in the SMSF conversation. People say, I'm really worried about what SMSF investors are doing. Well, why? Because they're outperforming most of the funds. That's what they're really worried about. The SMSF guys are doing really well.
The momentum's there in the market.
Absolutely. We will go and take another very quick break. We'll be back after a one or two words from the sponsors. We'll talk to you soon. Welcome to Your Money, Your Call. I'm Mark Todd from the NAB, and we'll cut straight to the chase because this is the last segment of the night. I want to talk about Rudy's idea on defensive versus cyclical stocks. He's brought a chart in here for us to share, and I wanted to get your thoughts on it, Rudy.
Well, quite some questions asked about whether some people are actually not by nature bond investors who are now forced in the share market and trying to treat the share market as a bond. Yep. And I thought, I picked this one up from Merrill Lynch this week, and I thought this was quite interesting because it shows the different types of yield. One is defensive and the other one is cyclical. So the cyclical is on the left and the defensive on the right. But you see that in different markets they actually perform negatively.
Yep.
So from the moment the market starts moving up, the yield that's defensive gets a negative response and has a negative return. So you have to be careful that you don't just have a defensive yield which hasn't growth attached to it, or you might be caught in between, like I'm having my dividend yield, but you never can sell because your asset prices
they've gone down. So that's a good point. I mean, it's about that portfolio construction. We go back to question one. It's about how you construct it. Am I cyclical or just purely defensive?
But also be careful if you go to the share market as well. Make sure there is some growth attached to what you do. Because otherwise, it is about growth.
Couldn't agree more. You've got to have that growth asset. Gavin, you brought a chart. You're famous, so. If we can bring up Gavin's chart, and the show is just flowing tonight. Have we got the right clock on? This is ridiculous. Gavin's chart is a Bloomberg chart, and what is that, mate? It's on Qantas?
Yep, this is Qantas's credit default swap. For those viewers who may not be familiar with credit default swap, it's basically the spread. What's the risk? You see there...
This is the professional market's interpretation of the risk on Qantas bonds?
Correct. So you got the big jump that you can see there. That's when the downgrade came out, when just before Christmas, around December, when Alan Joyce came out and said, we're going to make a $300 million half-year loss.
Yeah.
Bang, the spread goes wide, and it stayed there. It's about 300 over, which is almost a 7% return, up that high 7% return yield for investors. I think it's the best value, high-yield bond in the market. I think at 300 over...
This is not a NAB recommendation, I can assure you, but anyway.
For me, well...
It's Gavin's recommendation.
It's a high yield. Purely as a high yield.
But you look at that chart, the way it's rallied so hard as well. The V that you can see after the spike up.
Correct.
I mean, that's when all the Asian private banks were buying that. All the people who understood credit, that was 7.5% return.
Exactly.
And they get that out at 6.5%.
As you're well aware, I called the top and I called the bottom.
And the top and the bottom. So we're not saying buy Qantas for those folks. That is a high yield bond.
It's got its risk.
It's something to talk about, but it's not something to buy as your first bond.
No.
You definitely don't buy the equity.
And you don't buy the equity from Rudy. So, I mean, I'm sure they're trying their very best. I'm not saying anything about Qantas. I've got no idea. Well, I do, but you what? Yeah, buy them. They're good. I think they'll be all right. It's just...
They'll be fine.
They're a big company. They're going to be fine.
Market cap, 2.5 bill.
2.5 bill. I mean, and you've got 250 in front. Yeah. Goodbye. That's all we have time for tonight. It's been a great show. I want to thank my guests, Gavin Madson, a credit analyst at FIIG, and Rudy Philippek van Dijk from FN Arena. And to you, all the viewers. And we've had some calls. We've taken as many of the calls as we could. There are some that will send us emails, which is great. Until next time, I'm Mark Todd from the NAB. Have a great Friday night. Go the footy teams that you love.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.